Okay, for the question, the topic 15, operational risk management and regulation. First, the operational risk is the risk of loss due to the inadequate internal process, the failure from the system, people, or from external events. There are 7 types of operational risk. The first is the internal fraud. Second is external fraud. The third is client and business practice. The fourth one is employment practice. The fifth one is the damage to physical assets. The sixth one is the system failure, and the last one is the procedure and management failure. To model for operational losses, banks usually use the frequency and severity of the losses in the history, and they also want to use value risk and expected shortfall, which is based on the distribution and profitability of the loss. Let's move on to the model that they developed. The first model is the business indicator approach. It's a model that calculates the capital requirement for the operational risk by Basel, and the requirement here is that bank has to keep 15% of the gross income. So this model is quite simple. So then they developed into another model later, that is a standardized approach. This approach is similar to the first one, but it divides the bank into many different business lines, and each of these lines have a different percentage. They also developed a model called alternative standardized approach. This model is similar to the standardized approach, but they change, instead of the gross income, they change into the loan-based indicator. After that, they develop into the advanced measurement approach. This approach bank calculates their internal model with 99.9% of operational losses, and in this model they use the historical data and also based on their scenarios. The latest model is the standardized measurement approach. This model depends on the business indicator and also the internal loss multiplier. The business indicator represents the bank's size and risk exposure, and the internal loss multiplier is based on their loss on the last 10 years, and the capital requirement for this is equal is the multiplier of the business indicator and the internal loss multiplier. For the crisis risk, crisis risk is a risk of losses due to the damage of the company, that the company cannot handle it based by its normal operation. So there are 3 phases in the crisis. The first is the pre-crisis, the second one is the middle crisis, and the third one is after the crisis. And before the crisis, bank should prepare and forecast which scenario they may come and prepare the the way to tackle it. And in the crisis, the bank needs to have a very decisive leader that can have right decision to tackle the crisis, and also have a good building good trust with the media, manage the media, and trying to keep the shareholder in the company. After crisis, bank now can learn from their past mistake and then rebuild the trust that may have been broken during the crisis. Ôi, câu này tự đọc trong 5 phút. Không.
Thực ra có 5 phút bị hỏi.
Thực ra là tôi có thể làm cái trò kiểu phát âm không đúng lắm ấy, xong rồi người ta sẽ hỏi hả? What you mean?
Tại sao lại phải làm trò đấy? Không chích lọ đâu.
Thực ra tao không muốn chích lọ đâu, tao đọc thế nào đọc. Nhưng phần lớn là
bao nhiêu một câu thì tầm bao nhiêu trang?
2 đến 3. Phần lớn là kiểu mình đang nói nửa xong thấy cô cái show kiểu
Thế á? Cô ngắt vào. Xong thầy cô bọn tôi không ngắt. Thầy bọn tôi nói xong
xuống.
Chứ kiểu ngắt vào là mất hết cả mạch, cái mình sẽ quên mất.
Thì ngắt vào là cho kiểu học hiểu chứ không phải học thuộc thì biết thế.
Nhưng mà cái vấn đề là bọn tớ là có keyword. Nhưng nếu mà ngắt cái mạch thì là mất luôn keyword luôn á, bởi vì những keyword nó cũng liên hệ với nhau.
Biết rồi. Khoa tớ sẽ có tầm 2 phút để chuẩn bị. Có thể ghi keyword ra.
2 phút rồi. Bọn tớ có...
Ai yêu.
Bọn tớ có 10 phút lắm.
10 phút để chuẩn bị.
Thì tại vì là lúc cái đứa kia nó lên để nó thuyết trình thì mình ngồi ở dưới thì mình viết.
Bốc đề trước rồi người
okay. Minh Đặng bảo là có thể trích lò để có thể dùng điện thoại được, nếu như điện thoại.
Okay, next question. Let's move on to the banking regulation supervision. So, bank really needs regulation. Why? Regulation. Luật pháp, luật lệ.
Đó là pháp luật lệ. Thế giờ đây lại là human regulation.
Bank really needs the regulation because the bank works in industry that builds on the confidence of the customer. It builds on trust. Secondly, bank has a very risky business. It has a mismatch between the assets and liability. And the third one is that banks are interconnected to each other. So that people have to ensure that bank that there is not a systemic risk in the bank that may happen when there is a bank run, that a lot of customers want to withdraw a lot of money in a short amount of time, and which then leads to the failure of a bank and leads to the other failure of the other bank. And so there are two main types of regulation: the macroprudential and microprudential. Thận trọng. These regulations are to ensure that the financial stability of the bank. The macroprudential will ensure the stability of the whole financial system, so it prevents the systemic risk. The microprudential will try to mitigate and monitor the financial distress risk of a single bank. So it tries to see if the bank having enough capital adequacy or following the risk exposure. For the macroprudential, they have 3 dimensions. First is time dimension. It means that it's try to stop the build up risk over time, like build up the bubbles. The next is a cross-sectional dimension, which is trying to stop spreading the risk between the financial institution. And the last one is structural. it is to build a good a good regulation for the banking system. The tool they use in the macro prudential that they can use is deposit insurance. So they protect depositor from losing money, and the depositor can gain some money back if the bank fails. The second one is the lender of last resort. It is used by the central bank to stop bank from being too illiquid during the crisis. The Basel have been setting regulation about capital requirements of the bank. The Basel one set the requirement for the capital risk for the credit risk only, and it calculates about 8% of total risk-weighted assets. The risk-weighted asset is divided into 4 groups, and each group is assigned based on their risk and will be assigned a percentage. 0% is for cash and gold and bond. 20% is for the loans to other banks. 50% is for mortgage loan, and 100% is for commercial loans. There was this amendment for the Basel in 1996 where the market risk was introduced, and they also calculate the capital requirement of 8%. In Basel II in 2006, they developed in new rules, and this Basel has 3 pillars. The first pillar is the minimum capital requirement, which require 8% of the risk-weighted assets from the credit risk, market risk, and operational risk. They also show the approach to calculate the risk from the standardized approach and internal based approach. The second pillar was supervisory review. This is basically to monitor that bank follow the rules and follow how the capital requirement is calculated and what are the risks they're taking, and if they are having enough capital. The third pillar is about market discipline. It is to encourage the bank to disclose their risk exposure, to share the method calculating the capital requirement and the risk. And until then, after the crisis in 2008, the Basel III has been established. In Basel III, there are 6 main elements. The first element is to raise the minimum capital requirement for the tier 1, which is mostly common equity, to 6.5%, and they also introduce a capital buffer. First is a conservation buffer. This buffer is 2.5% to ensure that bank can hold on during the stress days, and they also include the counter-cyclical buffer, which is from 0 to 2.5%. So if the economy is doing well, they can store more money, so they can spend it during the bad time. They also introduce liquidity ratio. So the first one is liquidity coverage ratio. It is to ensure that bank has a high quality liquid assets during the next 30 stress day. And then they also have the net stable funding. It basically means that the bank needs to ensure it has enough funds for its operation in the long term. After that, they also introduced leverage ratio with a minimum ratio of 3%. And so now the total capital they require is not 8% anymore, but gonna be 10.5%, and can be up to another 2.5% for the counter-cyclical buffer. So continue to the FED and ECB. FED is the Federal Reserve System, and ECB is the central bank of USA, let's say, and the ECB is the European Central Bank. And ECB manage many other banks in many countries, but the FED only manage the USA. ECB have one main mandate. It is to control the inflation, to have the monetary policy. So it tries to keep the inflation at the 2%, whereas the FED, the Fed, have double mandate. The first one is also about controlling the inflation interest rate, and second one is to control the employment rate. Let's talk about the first question, the capital structure. So capital structure is a relative proportion of debt and equity that the firm used to finance its business. So having capital structure is important, that people can find an optimum point where there's this ratio of between debt and equity that can help the firm to gain the maximum value. But before that, let me talk about the theorem and how we come to this. The first theorem states that in the perfect market condition, which is when there is no tax, no transaction cost, then the capital structure will not affect on the value of the firm. So how the firm finance its operation, how much debt they have, or even they have no debt, it won't affect the value of the firm. And after that, the proposition 2 stated that as the leverage increases, the cost of equity also increases. However, the total cost of capital, the weighted average cost of capital, will stay unchanged. This is due to the fact that as the firm raises more debt, then the firm has a higher risk of being bankruptcy or not being able to pay the debt. So that now the firm has high risk, and the shareholder of the firm will require a higher rate of return on their equity as they're taking more risk. After that, in the real world, when there is tax, when the firm raises more debt, then because debt now is tax deductible, so the firm gain the tax shield, and then the firm can has a positive effect on its cash flow, which then increase the firm value. But this only happens until a point where the benefits of the tax is equal the risk of financial distress of the firm. Okay. Next, let's talk about the cost of capital. The cost of capital is a minimum rate of return that the investor require on their investment on the firm for both shareholder and both bondholder. So the Cost of capital has two elements. First is cost of debt, and second is the cost of equity. The cost of equity is priced by using the CAPM model, which is the capital asset pricing model. This model shows that the return on equity that the investor wants equal the risk-free rate plus the beta multiplied with the market risk premium. The risk-free rate is a rate of safe investment, like government bond. The beta is a sensitivity of the stock to the market change. The market risk premium is the rate of return that investors require more when they take more risks than when they take the risk-free rate investment. Then we have the cost of debt. The cost of debt simply is just the rate interest that the firm has to pay for the bondholder. So they may issue bond and now they will pay an interest on the bond. Basically, it's the due to maturity and plus default rate. And now we can go back to the MM theorem with tax. When there is more, when the firm has more debt, then even though the debt is cheaper than the equity, but because now the firm is much more riskier, so the investor will require higher cost of equity for their return. So it only happens until a point where a firm can gain some value, until a point when the financial distress, the risk outweighs the tax shield that they have. So to estimate the required rate, the total cost of capital, we use the weighted average cost of capital. It's equal the proportion of debt per the firm value multiplied with the cost of debt multiplied with the 1 minus the tax rate and plus with the proportion of equity multiplied with the cost of equity. Let's move back to how we calculate the cost of debt. For debt, we start with the yield to maturity, but if there is credit risk, we subtract the expected loss. So the cost of debt equal the yield minus the probability of default multiplied with the expected loss. Next, let's move to the derivatives. Question 8. Future forwards and swap. Forwards is an agreement to buy or sell an asset for a price. This is called strike price at a date in the future. And normally forwards are traded on the over-the-counter, is OTC market. Future are quite the same, but they are traded on the exchange, and normally they are standardized deal, so there is a fixed amount of quantity for the underlying assets. And one of the things that is very important is that future are marked to market daily, so you see the price change every day and you can realize your profit and loss every day. And because this is traded on the exchange, so one of the benefit of the future is that you can that the futures are more liquid than forwards, because the forwards are the agreement between two individuals. So to price the forward, the value of the forward, we just need to discount. Let's say the price of the forward is F, and this forward is for the stock, then the stock price right now is S, then the F will be equal to the S multiplied with e to the power of R and T. And if the future and if the swap if the underlying asset of the forwards has dividend, no dividend, then we just need to minus their income, the no income, inside the formula. And if there are no yield, we just need to add R minus the yield. Next to the swap, yes, the forward, from this forward we know the arbitrage price range. So if the actual price of forward right now is larger than the fair value for with that we can check from the formula above, then we can see that the forward price right now is expensive, and then we can short the forward and buy and borrow some money to buy the underlying asset today, so that at the maturity date we will sell that underlying assets based on the contract. And in the opposite way, if the forward actual forward price is cheaper, then we can long the forward, and then we do the short, we short the underlying assets. Next we can move on to swaps. Swaps are the agreements to trade the future cash flow between two parties in the OTC market. And normally there are three types of swaps. The first common type is the interest rate swap, when one party will try to exchange the fixed rate for the floating rate from the other party. The second one is a currency swap. So two parties will exchange their future currency, the future currency, and let's say this one in the next few months they have some USD and they want to exchange the euro for the other party. The last one, it was quite popular recently, that is credit default swap. Actually it is more like an insurance where the seller will give this insurance for the buyer. So if an entity like a company or a country will default, then the seller will give the buyer some money, and the buyer has to pay the premiums, spread premiums for each period. The next topic of derivatives, we have the options and the Greeks. So options are the right to buy or sell an underlying asset at the price in a date in future. So we have two type options. The first is call option, which is the right to buy, and the put option is the right to sell. There are three main type option. The first is American option, that is an option that we can exercise, which means we do the right or buy before the expiration date. The second one is the Bermuda, and the third one is European option. The European can only be exercised at the expiration date, so the Bermuda is a mix in between. It has some more flexibility, and there are many more type of option like Asian option, exotic option, but they are less common. For the moneyness of the option, the moneyness option refer to the relationship between the strike price and the underlying asset price, let's say stock, so it's too easy for the easy. So if it is at the money, it means that the strike price equal the stock price. If it is in the money, then if we exercise option, we will gain some profit. If it is out of the money, then if we exercise the option, we will have a loss. For the payoff of the option, because now there are two sides, the buyer and the seller, and also the call and the put option, so we have two functions to pay off: long call, long put, short call, short put. And for the call option, it usually the maximum of if the stock price is larger than the strike price plus the option price, then when we do a long call, then we will have a positive payoff. To price option to see how much it is, there is this model called Black-Scholes Merton model. So this model is for European option, and it is with the assumption that the option will have the constant volatility, and also it does not has any dividend. And the formula for this is the C equal the S, the stock price, no, strike price, stock price multiplied with the ND1 minus strike price multiplied with the E to the power of RT and multiplied with the ND2. The ND1, ND2 is a cumulative normal distribution. To see the risk, then people use Greeks to assess the risk of the options. So we have the delta. Delta measure the sensitivity of the option price to the price change in the underlying assets. We also have gamma. Gamma calculates the sensitivity to the option price due to the change in the delta, rate of change in the delta. We have vega is sensitivity to the volatility change, and we have theta is the change, is the sensitivity to the change of the passage of time. We also have rho. Rho is based on the change in the interest rate. Let's move on to the topic 3, the working capital management and short-term financing. So working capital is equal the current assets and minus the current liability. So it is what the firm has right now, which is can be cash, receivable, and inventory, and minus what the firm owns, it is payables. So managing the working capital well, meaning that the firm can keep the balance between cash, receivable, payables, and inventory, so that they can ensure the smooth operations and they do not need to borrow too much. So first, the reason why they need to have cash in the firm is that they have three reasons. The first is to run their day-to-day operation, like paying bills or paying for the material or transaction. The second reason is that they keep some amount of cash for emergency needs, and the third reason that is to ensure that they meet the bank requirements, so the bank will lend them some money. And for the international firm, it's very important to manage the cash, because now their subsidiaries will have the base in different country. So the way they do the cash management now is through cash pooling. The first method is physical cash pooling, where all the subsidiary will send money to the single master account, and then from this account, if any subsidiary needs the money, then the money will be transferred to that subsidiary. And we also have notional cash pooling. This is when it is similar to physical, but there is no actual transaction here, but the bank will have them to balance the account. And people also use the hybrid way, is the mixed based on this. For the inventory management, it is important for the firm to keep just enough of inventory. If they keep too much, then there will be some cost. The first cost is the acquisition cost, is the cost of buying. The second cost is the order cost, is the cost of transferring and or commission fee. The third cost is the storage cost, is the cost of keeping the inventory in the warehouse, for example. And they also face the risk of losing the value or damaging the inventory in the future. And if they keep too little inventory, they also may face the risk of losing the business deal and the customer. Move on to the receivable management. Receivable is money that they are going to receive from their customer, and to have a good management for this is mean they need to have a good collection policy, trade credit, the credit policy. And furthermore, they need to monitor if the policy worked effectively by using tools such as the aging schedule or account receivable days. Next, we have payables management. For payable, it is money that it owes to the supplier. So the idea is that the firm try to delay to paying as less as possible, and they also should choose the suppliers that offer them the best discount or cheap credit. Let's talk about the sources of short-term financing. So it is when the firm needs short-term money for their daily operation. They can find in several ways. The first way is through the bank loans. So it's straightforward that the bank borrows some money, the firm borrows some money from the bank. The second way is a line credit. So it's similar to a credit card, where the firm can borrow up to a maximum point at any time, and they will pay money for the money they use, and they also pay an amount for the money they don't use, which is a commitment free. The firm can also issue a commercial papers. The thing is that for the commercial paper is that it's an unsecured debt, and it's only for the credit worthiness, and for the large firm that has a good credit worthiness. The last way they can rely on is from the trade credit. So trade credit meaning that the firm can buy now but pay later, and maybe the supplier can give them the discount for 2% if they pay early in 10 days, and if not they will pay the full amount, so the firm can take advantage of this. For the firm, trade credit is also a financing source where the firm can offer is the customer to pay earlier but with a discount. So actually the firm also bear some interest in here when they give the customer the discount. For the deposit and payment service of the bank. So deposit is a main fund for the bank where people give the bank money, and the bank will send them, repay them interest. So in the balance sheet, the deposit, the bank stay on the liability because it's what the bank doesn't own, and they have to return for the customer. In the profit and loss, the deposit is in the form of the interest expense because the bank has to pay an interest for the depositor. There are three main types of deposits. The first is the sight deposit or demand deposit. This deposit is like current account or checking account, and it has the highest liquidity. The customer can withdraw their money at any time, and normally this deposit has very low or no interest rate at all. It is used for the daily transaction. The next time is time deposit. So the customer will deposit the money into the bank for the fixed amount of time, like 30 days, 90 days, or 120 days, and the bank will pay them an interest. This interest is higher than the sight deposit, but to withdraw this is harder for the customer, and they also face a penalty, or they won't receive any interest at all. The last another one we have is the certificate of deposit. It is similar to the time deposit, but it is issued to the institutional investor, and they can be traded on the secondary market. Next, the bank can also have the deposit insurance that to have to repay the depositor fully or partial amount of money that they deposited in the bank when the bank fails. So this is very important to build the trust of the bank. For the history payment service, payment meaning that to transfer the money from the sender to the receiver. So in the past, the payment was made made by cash, and then they developed into check and card, and right now the payment can be made online through the online banking, or more standardized like messaging in the SWIFT system. For the payment, we can divide into two type of groups of system. The first is the open loop system, and second is closed loop system. The open loop system meaning that the payment we made can be from many banks together, whereas the closed loop system is within a single bank or single company only. So this is similar to the honors and off-us payment. The honors payment is a payment within a bank, and off-us payment is the payment from one bank to another bank. We can also divide into push and pull transaction, where push transaction is when the sender send an amount of money to the receiver, whereas the pull transaction is like when the payee wants to receive money and they will require an amount of money, and then the sender can pay that money. It is similar to when you go to shopping, and then the shop owner will set an amount on the machine, and you insert the credit card in, and you pay that amount of money. For the regulation, in the Euro they developed a thing called SEPA. SEPA stands for Single European Payment Area. It is to encourage the Europe to use euro as the main currency, and it helps that every country will transfer the money, for the banking system will transfer the money easier and more convenient for everyone. They also develop like an IBAN code to identify each bank in the region, and also they use a SWIFT system. SWIFT is a messaging system between the banks, so they can send the financing message to the other in a very fast way. We also have the PSD2. PSD2 stands for Payment Service Directive 2. So this Payment Service Directive 2 includes that the bank will have two-factor authentication, and there is two providers. The first provider is payment initiation service provider. This provider allows you to send the money from the bank without using your card. Another provider is account information service provider. Payment service. This provider will help you to manage all the account and see the information of the account and bank in just one app, just like using Revolut. They also include the open APIs for the bank, so that the third party can access the information with the permission. And this new technology is very important for the fintech innovations. So fintech stands for the finance technology. So now they have many areas that the fintech is developing in. First, we can talk about the payment area, and second, we can talk about having loans. So third is about investment. So for the fintech innovation, the banks now can develop many new services, such as digital wallets, or they can provide a loan from their app. And there is these two sides. The fintech is from the financial technology and company, and what they provide is the convenience of the customer with many new features, and they can be competitive. They can be a competitor for the traditional bank, but they can also cooperate with the bank to generate the new shit. So the fintech company can develop new service like budgeting app, peer-to-peer payment, digital wallet, you only using customer account data with the permissions. This innovation improve the customer experience, but also increase the competition for traders or bank, especially the retail deposit and payment space. They also can cooperate with the bank because the fintech company can gain advantage from the bank customer base, and also because the bank has a lot of funding and money, so they will help the fintech company to develop their product faster. Blend lại. Chung màu hay.
Bạn sinh
Yeah.
gọi đến sinh lên tôi chụp lên cảm giác không sinh.
Cũng cảm giác nếu ông cứ bảo xinh thì ngoài đời xinh hơn. Shit. Next, we have retail and wholesale loans. So loans is the main income of the bank. So the idea is that bank will give the borrower an amount of money and they will require an interest rate on them. And there are two type loans. The first is retail loan and second is wholesale loans. The retail loans is mainly for individual like us, for the micro firm, and this is a kind of standardized loan that the term cannot be changed. And the example of the retail loan, we can have the personal loan, credit card, overdrafts, or mortgage loan. There is also the loan from the state sponsor, like the loan with lower interest rate for the poor people. Well, for the wholesale loan, it's a more complex loan. It's negotiable, and it has a much larger size for the middle and large corporate. This loan can be very complicated, like syndicate loan, working capital loan, project financing, or structural financing. So project financing, structural financing are two specific common type of the wholesale loan. Project financing is a loan when a company wants to borrow money for the project only. So bank will lend money for this project, and this loan will be based on the future cash flow of the project. Normally, the company will also create a company called the special purpose vehicle. This company will manage the project. The second one we have is structural financing. Structural financing is a very complex loan where the loans are split into many parts, many payments, and the bank requires much greater guarantee, and bank can also use the tool like securitization, so they can gain the money faster for the loan. So basically the retail loan and the wholesale loan are different from their customer base, their size, the scale, and also how they assess the risk. Talking about how they assess the risk, for the retail loan, they mainly use the scoring. So there are two common methods they use for scoring. First is that they will be based on their customer income. So if the income is good and they have they have a stable amount of income every month, let's say, then the bank can lend them more money, and the bank can also based score the customer based on the repayment history. So if the customer has a good repayment behavior, like, then the bank will also can give them money to borrow. For the larger firm, for the wholesale loan, normally bank use rating. So the rating can still come from the repayment history, and it also come from the income of the firm. But now the bank also relies on more complex like financial ratio or wholesale loan are assessed using a credit rating system from either external or internal. For external, they can use the external rating system like Moody's or S&P, but these are only for the very large firm only. For the internal rating system, they can use based on quantitative or qualitative factors, like using financial ratio and leverage, on management quality or market position. And they can also use the 5C, it's the character, capacity, the capital, collateral, and conditions, to use as framework. Talking about the collateral, to ensure that the firm will repay their debt, and to ensure that to reduce the risk, the bank will require collateral and loan covenants to form their contract. So for the collateral, bank can require collateral like the building, the machines, like from the building, machines, or financial security, the warehouse receipts. For the bank can also use a personal guarantee from third party, like state guarantee, to ensure that the borrower are more trustworthy. Bank can also use a covenant in their contract to they are the conditions written in the loan agreement. First covenant is a positive covenant. Is the thing that the firm have to do, like such as tax compliance or keeping the business license. Second one is negative covenants. It's the things that the firm cannot do, like having new debt. So if the firm have new debt, they will face a higher risk of not being able to pay back. And there is also there is also financial covenant. So the bank will require the firm to keep the stable ratio, like the leverage or stable cash. Yeah. Move on to the credit risk management and regulation. Credit risk is a risk of losses due to the counterparty that cannot meet their obligations or cannot repay their debt. So to measure the credit risk, we first measure the probability of default. To measure probability of default, there are four main ways. The first way is to based on the historical data. So it's like counting how many times they have not paid their debt. The second way is through credit spread or based on the correct bond yield. So it reflects the market perspective on how risky the firm is. The third way is based on the rating. So people can use external rating from Moody's or S&P, or they can calculate it themselves based on they can calculate themselves. There is this common way approach to calculate, which is Ontman z-score. This z-score, if this z-score is based on the 5 different financial ratio, and if the score is larger than 3, then the probability of default is low, and if it's lower than 1.8, then it has a high probability of default. They can also be based on the merchant model. So this model consider the equity of the firm as a call option. So if the equity is lower than the debt, then there's a higher default rate. Talking about the credit value at risk. The credit value at risk is maximum potential loss from the credit risk over an amount of time like 1 year, during amount of time like 1 year, and at a confidence level like 99%. So to measure the credit value at risk, people can use 3 ways. The first is using the Vasicek model. This model is to calculate the correlation. The shit. So first they use Vasicek model. This model is based on the correlation and based on the economy. So if the economy is doing badly, then there is higher risk across the firm. The second one is using the risk plus. The credit risk plus is to use the distribution, a Poisson distribution, and it's not related to correlation. The last model is credit metric. So credit metric will be based on the credit rating, the change in credit rating of the firm. So if the firm has a worse credit rating this year compared to last year, then there's higher credit value at risk. Next, we have counterparty credit risk. The counterparty credit risk is a risk of the counterparty being default before the settlement. So to calculate for the counterparty credit risk, the bank can use credit value adjustment. So this adjustment will be reduced here. This adjustment will be used to minus the value of the derivatives in the assets. So when this CVA, the credit value adjustment, increase, then the profit income of the bank also will decrease. For the regulatory requirements, the Basel 2 and 3 has set regulatory requirements. So to calculate the credit risk, there are three approaches. The first is the standardized approach. The first is standardized approach. This approach is fixed weight based on external rating. This approach will use fixed weighted based on the external rating. The second one is foundation internal best rating approach. And the third one will be the advanced internal best rating approach. The foundation internal rating based approach will allow banks to estimate the probability default, while the regulator will provide the other input like the loss given default. The advanced internal rating based approach will let them to estimate the probability default, loss given default, and expected exposure defaults and other variable internally. So in all cases, the bank will calculate 99.9% value at risk over the 1 year horizon. But this loss will be for the unexpected loss, and for the capital shit. Market risk management regulation. The market risk blocks from the change in market variables like interest rate, currency exchange rate, commodity and stock price. To measure the market risk, people use value risk and expected shortfall. The value risk is maximum potential loss over horizontal time at the confidence level. The expected shortfall is average loss that is larger than the value risk. And to measure this risk, we need to meet 4 properties. The first property is the monotonicity. Monotonicity requires that if any portfolio has more losses, then the risk is also bigger. The second one is translation invariance. So if if we add an amount of money, the cash into a portfolio, then the risk is reduced by that amount of money. Next is homogeneity. So if we double the size of the portfolio, then the size of the risk measure also double. The last one is subadditivity. So the risk measure of the combined portfolio will be less than or equal the sum up to individual portfolio risk. So this also reflects that diversification can reduce the risk. To measure the risk of the stock, bond, derivative portfolio, people use different way. For the stock, they use the volatility and beta. They also use value risk and expected shortfall. For the bonds, the risk the bond faces is interest rate risk. So they use duration and convexity. For the derivatives, because they will use, because the risk is non-linear, so they will use the delta, vega, and gamma. For the portfolio, they will use volatility and correlations. About the capital requirement for credit risk for the market risk. In Basel, in the foundation fundamental review of trading book. In the fundamental review of trading book, it classify it is the expected shortfall for 97.5% instead of value risk at 99%. And for the time horizon, it introduced liquidity adjusted horizons, which is 10, 20, 40, 60, and 120 days. So it is based on how fast an asset can be liquidated. And thirdly, is the most important thing that this fundamental review trading book will distinguish between the banking book and the trading book. So trading book is the account where the bank buy assets and to sell it early for trading only, and the banking book is the normal activity of the bank line for loan. The fundamental review trading book also introduced two main ways to estimate the capital requirement. For market risk, the first is standardized approach, and second one is internal approach. The standardized approach will be based on the standardized approach. The bank will use formula by the regulators and calculate the delta, gamma, or vega. The internal rating approach, the bank will use a model to calculate built model to measure risk using stress expected shortfall.
Thì vẫn giữ cái thước ở trong nó. Còn tiếp theo thì kiến thức từ cái
How to calculate the market value risk? To calculate the market value risk, they can use based on the historical data. Secondly is based on covariance invariance model, covariance model. The third way they can use is the Monte Carlo simulation. So the variance covariance assume that the return follow no distribution